Welcome back. We're joined by Pramod Gubbi of Marcellus Investment Managers this afternoon to try and give us a perspective as to how they are looking at markets right now. Pramod, first off, great. A very good afternoon to you. Give us a sense. How are you seeing markets at this point, and especially this IT trade? Could it play out as at least a tactical buy opportunity currently, even now?
Thank you. Thanks, sir. Thanks for having me.
Great having you.
Yeah, I mean, look, assuming this whole new West Asia crisis doesn't sustain, I think you'll have to make some assumptions. Otherwise, the markets become, the markets are as it is hard to predict, particularly from a short-term basis. But assuming it doesn't escalate and reverts very quickly, I think we can look at the markets from a more constructive perspective. I think we've had 2 years of almost no returns. So valuations have taken some sort of a time correction. And also at the same time, we've been through 2 years of very lackluster earnings. I think last quarter we thought earnings could have bottomed out until the whole crisis began to erupt. But assuming it doesn't, I think there is reason to be more constructive. Of course, unlike the period immediately post-COVID, where there was a broad-based rally, I think we are looking at a more um, concentrated rally, particularly with quality coming back in favor, partly because in a relatively difficult macro environment, quality tends to do better as businesses are more resilient, balance sheets are stronger, ROCs are stronger, moats are stronger, and also quality isn't as expensive as it used to be right after COVID. So I think it'll be a more selective market. IT in particular, like you asked, I think it's a very tricky one. It is certainly cheap from comparison to historical multiple perspective, but it's also for a reason. There clearly has been lackluster in terms of growth. IT industry as a whole has come off from the high 20s sort of growth in the Northeast to low to mid teens, and now looking at least the large caps looking at high single digit sort of a growth. Partly the scale issue, but also having lost some share to GCCs. I think the bigger concern now is the threat of AI disrupting it. AI seems to be disrupting a lot of software businesses. The same seems to be affecting the IT services guys. I reckon, I think there should be a balanced approach here. Near term, of course, deflationary trends are clear. We're seeing it quarter after quarter. Impact of AI on existing projects is clearly deflationary. There is some merit in what the managements have to say in terms of AI creating new streams of business and new streams of revenues as well. The only question is the timeline on that. Is that going to happen now, or perhaps we're a few years away from it? I think the recent signs where a lot of software companies have said that the cost of tokens are prohibitively high. In fact, some of them have gone ahead and said that it's actually cheaper to employ engineers as opposed to the tokens. Could augur well for IT industry. Having said that, the long-term cost curve for tokens will also continue to come down. So it'll be a continuous grapple between labor versus capital, whether you're able to deliver an outcome cheaper using human engineers or with tokens. Net, we don't have any exposure to IT as of now. We are watching it very closely. Tactical, we don't do. So I'm sorry, I won't be able to answer that question. It is cheap enough. The rupee depreciation generally helps add a few basis points in terms of earnings growth, but the structural question still remains unanswered.
So, promote quality, and that's exactly where I was getting at. IT is one of those bellwethers in terms of quality. If you're avoiding that, what is it that you're buying in terms of quality? Financials, I would suppose, in a big way.
Well, I mean, quality is more of a factor than sector. Naturally, IT historically was bracketed as a quality sector because it's a hugely cash generative business, beautiful business model with significant percentage of repeat or recurring revenues, high ROCs, free cash flow yields have been fantastic, even when the multiples were close to the 20s. So it did meet the quality factor. But one important aspect of quality is also the moat aspect, right? Whether the industry or the business model itself is protected against any sort of technology disruptions. And that we've seen not just technology, but even competition from GCC has clearly taken share away from IT services. So while it still remains a very high ROE, ROC business, although that is also changing in the margin with the sort of new deals that we're seeing, data center heavy, capex heavy. But clearly, the moat aspect doesn't qualify it for quality the same way it did. Similarly, FMCG as well, right? FMCG was also one of the first sectors you would look at when somebody said quality is making a comeback. But FMCG is also being disrupted because brand has been disrupted as a moat thanks to digital marketing, where plethora of venture capital has come and created D2C brands. Similarly, the advent of private labels from retailers such as DMart and Star Bazaar is eating into market shares of the frontline FMCG companies, and likewise Q-commerce and e-commerce. So quality needs to be segregated from the definition of sectors, instead looked at from a business fundamentals perspective, and we find quality companies across sectors. Leave aside the commodity sectors, say oil and gas, metals and mining, who don't generate ROCs significantly north of cost of capital on a cross-cycle basis. Outside of that, within industrials, within manufacturing companies, healthcare, pharmaceutical, chemicals, I think there's plenty of presence of quality, high ROC, moated businesses with significant opportunity to reinvest for future growth. However, valuations today are a bit of a concern. But having said that, relative to the rest of the market, which wasn't the case back in 2020, 2021, where quality was clearly trading at almost twice the multiple of the market. Today isn't the case. It is possible to build a relatively, I wouldn't say cheap, but reasonably valued quality portfolio for consistent compounding in the future.
Very interesting. Pramod, what would I know that you're largely saying that there are bottom-up stories and there are bottom-up stories across sectors. So you're not able to talk about any individual stories, obviously. But talk to us about a sector which you believe could be the sector of the next 5 to 6 years, maybe where not all, but quite a few companies are getting underappreciated by the market right now, where there could be a good chance that things could unwind, maybe over the medium term. No tactical trades here.
Right. I mean, underappreciated would also mean that they are um, compellingly attractively priced, but I think those are few and far between. Maybe private sector financials is where quality and attractive valuations reside. Growth has been a challenge. CASA has been a challenge for private sector banks. But having said that, I think there is still significant quality. And if the savings rate picks up, then CASA could also come back into play, and you could see an uptick in margins. That's perhaps the only place where you will see both value and quality reside. Structural trends, I think healthcare clearly ticks the box. Clearly, the post-COVID era where health insurance penetration has gone up has clearly improved the profitability of a lot of hospitals. Alongside that, diagnostics, throw in medical equipment and pharmaceutical and API companies, you have a fairly diverse basket to hunt for, where there are some really strong businesses run by really good management teams with high ROCs and moats. However, value isn't clear here, but it's clearly a structural trend. In some ways, it's also defensive because healthcare isn't as exposed to the vagaries of the economic cycle. So that perhaps ticks the box in terms of your structural trend without compelling valuation attractiveness. The other thing that we are seeing as a result of the developments over the last 2 years, where the rupee is depreciated, tariffs is a global issue, FTAs are being signed with the EU and the UK and a whole host of other countries, is the renaissance of manufacturing exports in India. India clearly missed the manufacturing bus. I think in an odd way, this rupee depreciation has a silver lining in the form that a lot of Indian manufacturing companies are finally finding themselves being competitive in the European markets, in the Western markets, and being able to take share from some of their peers in Vietnam and China and Bangladesh. That perhaps could be a structural story unless and until we shoot ourselves in the foot, it does need some sort of help from the government and the policymakers. But I reckon the reasons to believe the time for Indian manufacturing exports has come.
Financials, healthcare, manufacturing exports. Maybe these are areas one should look at. Pramod, also trying to address the other question with regard to the rally that we've seen among other markets across Asia, right? We've seen some very strong rallies in some of those markets, Kospi and Taiwan and the like, right? Do you believe that we're at the fag end of that and some of the froth may actually come off as a result? Also, how are you looking at earnings? You know, there's one section of the market which feels that earnings has now topped out, and you'll see a sharp compression of earnings next year as this commoditization of chips starts to play out. Do you believe that that may well happen?
Well, it's hard to call this, right? Because this AI disruption has been unique. We haven't seen this sort of things. Some people might refer to the dot-com boom. Yes, there are similarities, but at the same time, there are very different dynamics working in this cycle. So I wouldn't hazard a guess in terms of calling a top on the earnings. Having said that, I think it's a pretty narrow rally. Kospi is pretty much two stocks contributing almost 50% to the index. And we've seen memory cycles in the past. They are brutally cyclical, which is why despite the sort of profit growth they are printing, they're still trading at almost low single digits and high single digit sort of earnings multiples. Clearly, the market is wary of that. Having said that, is there enough new capacity coming which will suddenly start pulling down the prices of memory? It's not going to happen until late next year, really. But the markets are always forward-looking, so you never know. But that's a narrow market. We're talking about two stocks. I mean, Taiwan, literally one stock. So outside of this, there's still significant opportunity to invest, not getting bogged down by the AI trade alone. In fact, in the US, the market is increasingly getting broad-based, moving away. The Max 7 has actually underperformed this year and underperformed quite significantly. The Russell 2000 is the best performing index, so US small and mid caps. So that market is getting broad-based. And that's the beauty of a market like the US, which is very, very diverse. You will always find opportunities across sectors, even if you don't want to participate in the frontline theme of AI. Now, what does that mean for India? I think the bigger issue in terms of attracting foreign capital is the US bond yields. We've seen Indian FII data being healthy for a long period of time, almost 2 decades, but these 2 decades have also seen the zero interest rate regime play out at 4.5% 10-year bond yield for the US. The hurdle rates that a US allocator will need to invest in an emerging market, given the country risk, the currency risk will be that much more. So I'm not going to get excited about the FIS coming back, although I think valuations are a lot more attractive today compared to say 2 years ago. But yeah, I mean, we'll have to be more bottom up and fundamental in our approach. In some sense, the only factor which bodes well in terms of foreigners coming back is the quality renaissance. If quality comes back, and foreigners have always had a bias towards quality, if quality comes back as a play, then we could see some bottom up single country funds starting to buy Indian quality.
What's the just give us a sense, one market narrative today which you believe investors are accepting too easily and which will likely unwind maybe in another 2 to 3 years. What's your sense on that one?
Well, I think one of the things that people are saying is that India has finally financialized its savings, and the flow into domestic mutual funds will continue to keep the market quite elevated and prevent some sharp downside movements, which has been the case in the last 2 years, despite significant selling from foreigners. We have seen the market hold up, albeit it hasn't given much in terms of price returns, but we also haven't seen significant correction in the market, and thanks to the inflows from domestic mutual funds, who continue to see inflows. I'm not sure if that will be enough to sustain should the earnings growth doesn't pick up, should valuations don't get more attractive. Just believing that the flows will ensure that Indian markets will continue to give good returns for the long run, I think is a bit too strongly held belief, which could get questioned.
Thank you so much for coming in and speaking to us, giving us those views.
Most welcome.